Hello, everyone, and welcome to today's DAS webinar, Building the Next Generation of Financial Products. Today's episode is made possible by Algorand. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A button at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand. All registrants will receive an email once the recording is live. I'd now like to turn the event over to today's moderator, Scott Melker, host of the Wolf of All Streets podcast. Scott, please go ahead.
Thank you so much, Julie, and thank you everybody else for joining us. First, I would like to thank Blockworks for putting this together, but especially like to thank Algorand for sponsoring. Now, if you've followed me for any extended period of time, you know that Algorand's a project that I am very passionate about and something that I actually have held for the long term. So to tell you a bit about them, they're a next generation blockchain purpose-built for sophisticated applications of the future and the first pure proof of stake platform. Algorand has a vision for a world of frictionless economic exchange. It is powering the DeFi evolution by enabling the creation and exchange of value, building new financial tools and services, bringing assets on chain, and providing responsible privacy models. And in a world of DeFi where it's all anonymous projects and you have no idea what's really going on, Algorand has a team that includes multiple Turing Award winners, a Nobel Prize winner, and some of the most brilliant minds in cryptography, economics, and computer science. So thank you once again to Algorand for sponsoring this amazing project, and I encourage all of you to check that out when we're done. I'd like to introduce next our panelist, Sebastian Widmann, who leads digital asset and blockchain strategy at Nomura. Sebastian, thanks for being here. Tell us a little bit about yourself.
Thank you, everyone. So my name is Sebastian Widmann. As mentioned, I work in the wholesale digital office at Nomura. I got firstly interested into this space in 2014 when a friend of mine started a PhD looking at the decentralization of the web. After that, I went down the Bitcoin rabbit hole, read the white paper, and started conducting a bit of research in that space. After that, I seriously started researching the space at university. I studied at University College London. And there they had one of the leading research departments in the space, the UCL Center of Blockchain Technologies, where we started researching the widespread potential of distributed ledger technologies, not only in finance, but also in other industries. And from there, we looked at the widespread challenges at the time. That was 2015, 2016. After my graduation, I joined Nomura, initially in a business-led digital transformation project for the front office. And then when Nomura set up the wholesale digital office in February 2018, I joined the digital assets team there.
Really interesting. So broadly speaking, just to dive into it, what do you see as being the next generation of financial products?
Yeah, I think it's a very big question. It has different answers to it. I think the underlying technology is the most interesting part. So if we speak of distributed ledger technologies, there's a number of use cases. Back in the day in 2016, when I already started researching the space, there were a couple of use cases we were looking at. One of them being digital currencies, what we would refer to as cryptocurrencies, such as Bitcoin and so forth, that leverage the underlying properties of a blockchain technology to create a protocol and a consensus mechanism that on one hand incentivizes miners to maintain the network alive, and on the other hand incentivizes end users like yourself or myself to use it as a different means of payment, as a store of value. This is the first generation of digital assets, I would say, and there we've seen many more come up, as you mentioned, Algorand, Ethereum, and a couple of others, that will see a lot of adoption. The question is, are these also institutional financial products? And I think there's a big differentiation as to which ones will be and which ones won't be. And also, as in any startup world, we see a lot of these projects will fail. We'll see the maturity in market come up and more interest coming into these. I think the second area and also the second use case of blockchain technology is currently being explored is asset registry. So what many refer to nowadays as tokenization, as we see security tokens are purely digital representations of traditional financial assets. And that being either stable coins that we see nowadays, which obviously are pegged to a fiat equivalent in currency in some reserve, or the current security tokens on real estate, on art, and so forth, which simply tokenize a traditional SPV that holds ownership over this asset. And I think the interesting aspect is, as we progress in the future, obviously there has been a lot of discussion done on central bank digital currencies. We'll see native digital assets being issued on a blockchain where you don't actually have counterparty risk and where you have the front to end purely represented on a blockchain. And I think we've seen this in China being conducted. I think a lot of discussion is being done in Europe, in the United States, and it'll be the progress and also the next financial paradigm as we see it.
Let's drill in on a few of those topics that you touched on and get a bit more specific. I really want to talk about tokenization. It's something that I find incredibly interesting. Obviously, we're seeing a huge boom and interest in, when you get down to the really, really specifics, like NFTs, art being printed and scarcity proven using this model. And then, as you discussed, mortgages, financial documents. I mean, literally anything can be tokenized. What are the advantages of tokenizing these assets?
Yeah, there's a lot of advantages. The question is, obviously, that everyone speaks about tokenization. And in order to reap the full potential, you need, as mentioned also in the case of central bank digital currencies, a digital value chain that is front to back supported by a blockchain. So similar to the use cases as we nowadays with Bitcoin. Obviously, NFTs is also a topic, and projects that can take this end-to-end digital value chain. I know you are issuing your own NFT where you can create a native digital product and you can issue it on a blockchain, you can trade it on a blockchain, and you keep it custodied on a blockchain. It's much more difficult looking at securities because obviously there is multi-trillion in assets already being securitized and issued and traded nowadays 24/7 to some extent. It's very efficient and it supports the global economy. So the question is, how will this move on a distributed ledger? And it's definitely not a one-year project. It's, I think, a decade that will take before we actually see the full potential. There's a lot of prerequisites. There's a lot of questions that we have to answer. But there's a number of areas where we see potential. We already see potential today that we want to explore and to then pursue opportunities to reap the full potential. So to your question, benefits of tokenization include the fragmentation of assets. So for example, retail investors that to date have not had access to huge property developments and so forth because they simply don't have the budget, now can have fragmentations or pieces of these assets. Interestingly, 2 days ago, I was speaking with a very interesting company that's looking at the tokenization of valuables and collectibles. For example, they tokenize a Ferrari DFD for 500,000, give access to a number of investors to the value of these assets. So if in 2 years it increases in value, they can sell their stake as opposed to having the requirement of the financial capital at the beginning to purchase the whole asset and therefore also being exposed to the full risk. Other use cases are settlement finality, there's a transparency, it's immutability, and it's simply a more efficient way of trading. It's open 24/7. But obviously, you need a fully digital asset value chain in order to support this, from initial issuance to the trading, to the custody, to the right data in the space. And you need this whole concept to be regulated and expanded in order to make it efficient and be able to reap the full benefits.
Yeah, so those are a lot of clear benefits, obviously, to the end user and to the system, but there are also benefits to a company that decides to do this, right? I mean, most companies have, or historically have had, these massive server rooms and the guy in the basement who's managing this, and then it obviously moved to AWS and cloud servers and things like that. But doesn't tokenizing assets to some degree eliminate, I mean, probably billions or trillions of dollars in salaries, and it removes all the friction in between. It removes the man hours because it can all be done via smart contracts rather than by human beings.
Definitely, but that's obviously the chicken and egg problem. It's in industries, obviously, and you know that better than I do, how the financial system evolved from the early 1980s to today. A lot of this is automated, a lot of it is electronicized, and while it replaces some jobs, it creates new ones. So one of the biggest issues right now, I think we have in the distributed ledger space, is that there's not enough talent that knows how to build on these assets, build on these protocols, and create new ideas. And I think we'll see a real shift from old traditional jobs into these new technology jobs, will lay the foundation for the new economy.
That makes sense. So moving on a bit to, we touched on, institutional adoption, the idea of institutional money being involved in the crypto space, or at least being interested. What kind of tools need to be built for big money to really be able to enter this space comfortably?
Yeah, it's again a big question. It depends where you think the money should go. Is it speaking digital currencies such as Bitcoin? Is it security tokens? Is it NFTs? It's very different layers, and I think some will come earlier than others. I think the main interest looking at the first use case of cryptocurrencies is around Bitcoin. We've seen it to have the longest track record. It's the first asset. Initially, it was a test use case, obviously, and I'll tell you later about the journey that Nomura had in this space. But the use case of Bitcoin evolved to some extent from a payment token into a store of value. Initially, it was mainly used by retail traders. Now we've seen over the past year also a number of corporates adopting it, for the reserve strategy. So it just validates the thesis that Bitcoin can be used as a store of value. The question when institutions will enter is difficult to answer. There's a number of prerequisites for that, ranging from regulation to the technology and to the market infrastructure. Nomura is trying to solve for some areas of this. So obviously we launched a wholesale digital office in early 2018. That was just after the boom and bust of Bitcoin. It went first time, I think, mainstream, where you saw it on even traditional newspapers, you saw it on Bloomberg and everywhere, and people started discussing around it. So in early 2018, we looked at how to potentially gain exposure to the space. And at the time, there were simply not the prerequisites for an institution like Nomura, which is globally regulated in over 30 countries, to gain meaningful exposure for itself and for its clients. Obviously, it has to be trust-based, it has to be regulated, and you have to do it at scale. So when we started looking at the market, one of the biggest challenges in the value chain at the time was custody. There was simply no institutional-grade custody solutions that would meet any institution's criteria from a KYC perspective, from an AML perspective. Where did the assets come from? What security did they have? And you could simply not trade on exchanges. And at the time, in early 2018, to some extent even today, exchanges fulfill a large part of the value chain, potentially creating systemic risk if we see Bitcoin valuing to $1 million, as some people propone. And that is just not fit for institutions. So institutions need a number of segregated parts of the value chain that they can trust for a specific use case. So you have the custody business, which is something that Nomura has looked at early on. In May 2018, we announced Komainu, the first regulated digital asset custody solution. And we launched the company in 2018. It's a joint venture with Ledger, the leading technology provider, and Global Advisors, which now renamed to CoinShares, which is one of the leading digital asset fund managers. We launched the company in 2019, got regulated from the Jersey Financial Services Commission, and then announced the public go-live of the company in June this year. Since then, it has seen significant interest. I think it's in the top 3 in terms of assets under custody in digital asset custody businesses globally. And it's seen a lot of interest from different buckets of customers. On the one hand, they had institutions with an existing exposure to digital assets, be it cryptocurrencies or security tokens, that simply needed a regulated and fit-for-purpose custody solution that they couldn't find at the market at the time. And secondly, which I think is even more interesting, is we have institutions that to date haven't gotten exposure to digital assets, but are interested in finding the right partners, and I think Komainu is exactly that help them on their journey in order to gain exposure to the asset class, to understand more of it, to be educated in the space. And that's one of the first initiatives that we launched with Nomura.
So custody obviously addresses the security issue, which was a huge issue, as you touched on. For anyone to an institution can't really move hundreds of millions of dollars onto a ledger wallet and put it in a safe and hope that the one person who has the private keys can secure it, right? So that addresses that. But how can they actually transact in large quantities? Are we talking about institutional grade exchanges? Are we talking about OTC desks? What does that look like?
There's a mix of that. I think overall the trading and trading venues and liquidity in the space is quite immature. It's nascent. There's a number of companies that do it at institutional scale and more also institutional led, and there are also more the traditional players that are moving into the space. I think still most of the market is being serviced by retail exchanges. Some of these also unregulated offshore jurisdictions that provide wrong data. That's why there's a lot of missing gaps in the market. One being around data. You don't know how much is traded, you don't know where it's traded, and you don't know where the Bitcoins come from. And secondly, as you mentioned, to trade in meaningful size, you have to be able to do that at the right counterparty. This is something, if we looked at, for example, 2 companies purchasing Bitcoin for the reserve, one being Square, the second being MicroStrategy, the third, even today we saw Mode in London, that it was only 6.7 Bitcoins. They need to find a way to gain liquidity. MicroStrategy did it in 4,000 transactions. And Square did it purely because they had their existing infrastructure. They obviously service Bitcoin already for their customers. And so it's easier for them to have the capabilities in custody. They know where to source liquidity. And so for the mainstream institution that we see nowadays, it's simply too difficult to have to do it themselves. So they need to wait to some extent to find the right partners that are regulated, that can help them to gain access to the market.
So is that happening? I mean, do those partners exist en masse, or is that still something that's developing?
Yeah. So going back to your question, if institutional money arrived into the space, to some extent, if you look at Bitcoin, it's a 230 billion market cap, I think, today, and it's been the best performing asset of the year. This doesn't compare to the Fortune 500. It doesn't compare to an Apple. It's an eighth of the size, right? So to some extent, it's fairly easy to argue that institutional money is not in these assets yet. Institutional money, however, over the past 2 years definitely entered the market in terms of infrastructure, in terms of venture development. The way we did it with Combine, a number of other financial institutions did it with other areas of the value chain. We've seen more custody solutions coming up, but we've also seen security tokens platforms, more regulation being conducted in the space. And it's a moving target. Obviously, you can't change the world in a day, and you have to do it the right way. Most of these protocols are permissionless. If something goes wrong, you can't go back on that, and so forth. So you have to, if you want to retain the trust of your customers, it's not a question of who's first, but it's a question of who can do it right the first time. And that's the risk reward you have to manage. I think with Combine, we were there. The firm was comfortable that we have the best in class custody solution in the market. And now we're looking how to expand this into other areas of the value chain. But I think it's a moving target and it will take a bit of time.
So it sounds like there's a differentiation between whether institutional money is actually buying the assets or whether they're investing in the space. So what you're saying is that it's a bit of a picks and shovels approach, so to speak. There's more money to be made perhaps in owning the exchange or managing the custody than there is in actually trying to buy the assets for now. So perhaps that's how institutional money is initially being involved.
Yeah, no, I fully agree. And one thing, to some extent, institution could get exposure already. It's interesting to see when we talked about new financial products, but to some extent, something that we've seen increasing over the past months and years is structured or traditional financial products that are pegged or follow the price of cryptocurrencies. That would include exchange traded products on Bitcoins, that would include derivatives. And I think institutions to date, if they really want to gain exposure to the price, it's easier to do it through those means without having to hold the underlying Bitcoin, to have the security risk, to need to have the expertise in security and regulation and so forth. If they want to gain exposure to the price purely, they can do it through exchange traded products. But I think as we see the infrastructure in the market to develop, for institutions to be fairly easy for them to buy Bitcoin and put it into reserve, we'll see more of that also happening.
Interesting. So there's a differentiation then as well. Even when talking about derivative products, you have the cash delivered, cash settled like CME, and then there's backed, like physically settled. So you're saying that a lot more institutions may be comfortable with cash settled and never touching the underlying asset.
I'm not saying never, because obviously one part of the crypto proposition is that you need to hold your keys, to own your keys to some extent. But it's again, a moving target. It's much easier now if you're a fund manager to go and buy a futures, cash settled futures on the CME, as opposed to this to buy meaningful size of Bitcoin directly and then have to custody it and have to move it around. So it's an indication. We've seen futures grow significantly over the past month. I think we'll see it as well. There has to be regulation established. Obviously, a year ago, there was a big discussion around the Bitcoin ETF. It has slowed down now for some other reasons. But you need these products to be established. You need the right regulation in this space to enable more institutional involvement in the space.
Do you think that the ETF is the holy grail of that will open the floodgates to this market if that's approved?
I don't think it's the holy grail. I think it's a reconfirmation that the market is stable and that institutions can gain exposure to it. It's similar to seeing more and more corporates adopting Bitcoin as a reserve asset. It's simply an easier way of doing that if they wish to do so.
So it's interesting, and just what's happening literally today in the news. We're talking about the future of financial products and specifically with regard to cryptocurrencies, but we see news that was rumored but has been confirmed that PayPal is opening the doors to buying, selling, and purchasing things with crypto. What do you make of that, in reference to the size of the market and all the topics that we're discussing here? How important is it?
No, I think it's an extremely important development. It's also, again, a validation of the market that it's here to stay and that Bitcoin, to some extent, has been established as a financial product. But it's interesting to see what type of cryptocurrencies they'll be servicing. Obviously, Bitcoin, if you speak to most, I think, of the audience here even, they're Bitcoin maximalists that wouldn't spend their Bitcoin on a Starbucks coffee. So the question is, what other assets will PayPal service? Is it stablecoins? Then in that case, which stablecoins? Obviously, a number of stablecoins. If you want to send $1, it costs you 23 cents. Which works well if you send $1 million, but on $1, it makes a difference. And so it's again, it goes back to the moving target. We'll see more involvement in stablecoins. You need a fixed asset. You don't want to pay your coffee with a very volatile asset. But it's, again, a reconfirmation of the service. I think more users will start it. Obviously, it's a retail product. We'll see more merchants adopt the right technologies to be able to accept digital assets. We'll see more firms custodying digital assets, and we'll see more of the financial markets being based on digital assets.
I can only speak as an American, but the other barrier to purchasing coffee with your Bitcoin is that it's a taxable sale of Bitcoin every time you transact in it. So I think that there's also regulatory and tax issues that will come before we see that level of adoption, just touching on sort of what you're saying there. Going back to MicroStrategy's purchase of Bitcoin, do you think that this is the beginning of a larger trend of companies adding exposure to Bitcoin?
To some extent, yes. I don't think you see every company doing it by the end of the year. It's interesting to see what type of companies have done it to date. Obviously, MicroStrategy being led by Michael Saylor, a very innovative person who's done bold moves in the past. It can work out. On the other side, it can also not work out in the past years. If it's, again, a boom bust and we see Bitcoin dropping to 6,000 for a reason for a year, it's definitely not as good as a choice. These companies were innovator. There's a question why Jack Dorsey did it with Square versus doing it with Twitter. And Mo to some extent did it in London, but obviously it's their business model. It's interesting to see. I'm not sure how much we'll see over the coming year. Again, it goes back to the point of the market infrastructure. These companies either found the right partners to get access or they had in-house capabilities. Before you'll see the mainstream company doing the same, it might require some time. And I think they would go back to their traditional financial and service institution like a Nomura or any other that has a trusted name, that has a track record in servicing all their needs, not purely digital assets. And if they're comfortable with giving their client access to this industry, then I'm sure more and more clients will do so.
Yeah, most companies are not going to do what MicroStrategy did, as you touched on earlier, and 4,000 separate transactions to gain access. It's just not realistic to expect many people to have the pain tolerance or patience to do something like that. But I do think that it's a really, really big step in the right direction, and we are seeing others follow. I want to go back. We've touched on, obviously, ETFs and derivatives. What exists in the crypto market versus traditional markets, and what products do we need to see developed for us to really, really see adoption on that side?
I don't think it's a question of products. It goes back to the question of infrastructure and regulation. You need more clarity in the market. Bitcoin will always be used to some extent as an experiment. When we built the custody initiative, was not to service Bitcoin per se. It was to service part of the digital asset value chain of the future. And so I think Bitcoin might be part of that and will be part of it. But there's a bigger question as to the tokenization of assets and how you can create financial assets natively on a blockchain. I think that it will be the financial products that you need to see wider adoption, to see mainstream adoption also, because it becomes easier if you can service central bank digital currency. It's fairly easy to replicate it if it's on a distributed ledger, to replicate those capabilities and put them on blockchain, or also permissionless assets. And if you can do it with a permissionless asset where if anything goes wrong, you can't go back, and you're comfortable with doing that at scale, then it's fairly easy to do the same on a central bank digital currency or a traditional security on a blockchain.
And what role do you think that these products will play in seeing Bitcoin sort of mature as an asset, reducing the volatility a bit? Obviously, I mean, everyone knows that it's derivatives that sort of tame the market and setting a future price, and it makes the market more efficient. So will more adoption of that eventually lead to more adoption of Bitcoin and crypto in general, and obviously reducing that volatility that so many people fear?
On Bitcoin, definitely. But again, Bitcoin to some extent is one use case of a blockchain technology. So it's pre-coded. We know the properties. We know how many, the scarcity element. We know the transparency. And so definitely there are the properties. And I think this have been proven over the past years that Bitcoin can be an institutional asset. And how institutions see it, whether that is for payments or a store of value, that is still to be found out. And I think it will be a lot of time, as you mentioned, also the capital gains tax element. In Germany, you wouldn't pay capital gains on your Bitcoin earnings. In the United States, you do, for example, in the UK do as well. So it's interesting to see, as we've seen more standardization, as we see more regulatory clarity, to be able to adopt these assets at scale.
A company the size of Nomura, how do you navigate that regulatory environment when it is different from country to country? And I mean, in the United States, it's literally different from state to state. So how do you navigate an environment like that?
Yeah, it's through closely collaborating with the specific regulators. Obviously, we don't have global products. We currently don't service Bitcoin. But it's a moving target. We need clarity from the regulators. It's up to them. Obviously, they come for advice and to ask questions to get our sense of the market in terms of interest, in terms of maturity, and so forth. But ultimately, it's their decision. And obviously, with these things, you can't change regulation every 2 years, so you also have to get it right. It's not being first, as, for example, Jay Powell mentioned yesterday, around being the first in central bank digital currencies. Not as much as who is first, it's who can do it right. The question is, as soon as you have something on a permanent immutable ledger, to some extent, obviously these won't be fully immutable if it's issued by a central bank, then you want to automate as much processes as possible. And the more you can automate, the more you want to get it right, because if you get something wrong within the automation, then you have to retake the whole contract and reissue a new one. So it's more challenges. You can have efficiency, but you can also have challenges if you get the efficient initiatives wrong.
Well, CBDCs, central bank digital currencies, are really a hot topic issue in the crypto space and then in global economics as well. How do you see those affecting the crypto space? Because they're inevitable, in my opinion.
I fully agree. They're definitely inevitable. It's a sense of the market. Again, it's digital distributed ledger technology is a new computing paradigm. So it's the same way the internet improved financial services and the sharing of information. Blockchains will enable the sharing of value in a trustless manner. Digital currencies on a central bank level are very interesting because there's a lot of inefficiencies in today's economy and in today's financial markets. And therefore, it will be very interesting to see how this develops. Obviously, there's different types. So to some extent, you have wholesale central bank digital currencies, where you would have a Nomura transact directly with a central bank for clearing and settlement. And then you also have more general purpose central bank digital currencies, which I think is what you're currently seeing in China, where the central bank directly issues this central bank digital currency through wholesale bank to commercial bank to then either PSP or the payment service provider or the end user. And there it's interesting. There's a lot of benefits. There's also some challenges and some questions, as you mentioned, around privacy and so forth to be asked. But it's an interesting development, and it will validate the concept of having cash on ledger, which obviously will facilitate much more the security token space and to some extent also Bitcoin. Because to date, if you look at how Bitcoin is traded, the biggest trading pair is not Bitcoin and US dollar, it's Bitcoin and USDT, purely because it's much easier to have the concept of atomic swaps in terms of settlement efficiency and security and speed. So as soon as you have cash on ledger, if you manage to transact USD from a CBDC to Bitcoin, and people are comfortable with using CBDC in their everyday life, then it'll be fairly easy for them also to purchase Bitcoins.
Right, but I don't want people to get the idea when thinking about central bank digital currencies that they are cryptocurrencies, because really they are truly just a digital version of the dollar. Money will move with less friction, but it's not going to change the policies of money printing. In fact, it gives the central bank a much stronger control over the money supply, right? I mean, they will literally know where every single dollar is. It basically eliminates cash and private transactions and anything that's outside of the purview of the government.
Yeah, but that's good to some extent. Obviously, there's challenges because money makes the world go round to some extent, right? So the more a central bank or a central entity has control over money, the more they can control everyday's lives. The question there is, what will you as an end user use? Obviously, if you have CBDC being issued, you can, I believe, have a choice if you want to use the CBDC from your government and if it covers the right privacy issues, the right functionality that you're comfortable with in using. Otherwise, you could use a traditional stable or the today's stable coins, USDC, that is pegged to a CBDC. And then you would leverage new properties in potentially a more privacy manner.
So go ahead, sorry. Please.
Just to add on that, there's also massive benefits in CBDCs. Obviously, when we looked at Bitcoin in 2014 or in general, banks weren't really looking at it because the biggest use case was, they said it was terrorist financing and so forth. Obviously, that wasn't entirely true because cash is used in all terrorist financing, drug traffic and everything. If a central bank has more control on anti-money laundering and all these processes, it's much easier to find the bad actors in the system, and it gives the right level of control to state. Obviously, again, going to the point to having to get it right, you need a lot of governance around this. It's a system that, to some extent, can create a systemic change, and so you want to get it right and ensure that you have the right level of control and freedom for the end user.
Yeah, I always find the notion that Bitcoin is for criminals and money launderers to be so absurd when we know that no currency has been used more than the US dollar for that very purpose. I mean, we even just saw JP Morgan basically get a slap on the wrist for decades of money laundering for criminals, right? So I just had to address that because it bothers me every single time I hear it. And I wonder if the digital dollar will actually eliminate that or if it'll still be sort of an overlooked practice.
I mean, I think cash won't leave tomorrow, right? So the question is, how long will it take and what level of control is it? For illicit trade, there's always going to be ways and means for illicit actors and bad actors to find a way through the system. It might be through Bitcoin, but Bitcoin nowadays you can't really use for money laundering to some extent, because obviously you can also trace any transaction, you know who owns how many Bitcoins, you know where these Bitcoins have been in the past. There's new currencies that to some extent mask your identity. And if these will be adopted at scale, obviously, then also you have difficulties in tracking where the money is flowing. So right on off ramp from central bank digital currencies to these and to really block them. And for that, you also need innovation in the space to ensure that you have more control and overview.
Right. I mean, the most control that a government can have, they can't ban Bitcoin per se, but they can certainly make it very difficult to get dollars in and out of it, which then you would need to do to convert to those privacy coins and be able to transact. So it's another chicken and egg. You'd have to sort of have been in the space and opted out of the dollar to be able to get those privacy coins in the first place, right?
But again, yeah, it's definitely not Bitcoin. I doubt any government will ban Bitcoin at this stage. It's more the privacy coins.
Monero and right. Yeah, that makes sense. So this is all still very nascent. You're at a 100-year-old financial institution at Nomura. How do you assess risk and opportunity within this space in general?
Yeah, perfect. Before answering the question, let me give you a bit of context also on Nomura. As you mentioned, it's a 100-year-old financial services institution. From the early start until today, we're one of the largest globally regulated financial services institution, and we had to do and to keep innovating over those years to maintain this position. It's something that we're sure and we want to ensure that we retain over the coming century. And therefore, we've always had to innovate and look at how emerging technologies and new products would impact our traditional business models. So Nomura, I think, is one of the leaders in this space. Early on, we've looked at distributed ledger technologies and their potential. When I joined Nomura in 2017, already in 2014, they've been looking at blockchain use cases. At the time, obviously, because of the discussion around Bitcoin has purely been around illicit trade of funds, no one internally was talking about digital currency having any potential as a store of value. But at the time, they understood the properties of the underlying technologies and just asked themselves, how could we apply these fundamental computing algorithms into the operations of the banks? At the time, quite early on, we understood the concept of a native digital asset. Initially, it was more what we called enterprise blockchain use cases. So looking how you could create a digital contract and share it between parties without having an email. You saw what timestamp was, what changes were made, and so forth. And it created initial efficiencies. And also early on, we looked at native digital assets in the concept of financial products. And we started looking at this space. We made a number of investments in this space. We joined quite early on R3, one of the enterprise blockchain consortia. In Japan, we launched a security token company with NRI, looking at the securitization of assets. And then since then, we've been looking at the overall market as well. So obviously, I joined in late 2017. And at the beginning of 2018, we launched the wholesale digital office. So focusing on the wholesale division of Nomura. Wholesale is the capital markets arm. So that includes the global markets and investment banking. And it was at the beginning of 2018, there was more and more interest around Bitcoin, really, because it was in the news 24/7 across 2017 at the beginning of 2018. And so we looked at the potential of seeing it as a financial asset. And there were challenges, we couldn't service it, but we saw that the opportunity of creating a custody company in the space that could then also service security tokens as these would reach widespread adoption. And security tokens are a much longer journey. You need regulatory clarity, you need international standards, you need interoperability. There's multiple challenges that you need to solve before you see these adopted at scale. And we think that looking at the current digital asset value chain, such as within Bitcoin, if a bank like Nomura manages to serve that in a secure, trusted, and regulated way for its clients, then when we see the widespread adoption of security tokens, we'll also be able to be one of the fast movers in the space.
Can you talk more about security tokens at a very basic level, what they are and why they're important?
Yeah, so security tokens to some extent, or nowadays, are digital representations of traditional financial assets on a blockchain protocol. They can either be permissioned, whereas a central entity controls the rule of the network, or permissionless in the case of what we're seeing with ERC20 tokens, the number of other the token standards, or the smart contract standards around permissionless networks. There you can, for example, tokenize anything from a building to NFTs as well, to cars, real estate, as well as debt offering. And the idea is, because of a set of smart contracts, you can also automate some processes. So taking the example of a bond, if you create a digital bond, as something that Nomura has done in Japan, you can tokenize it and through smart contracts create automate coupon payments, automate reconciliation, and also reduce the time to market from the go live to the actual cash in bank. There's still multiple challenges. To some extent, when you buy a digital bond, you don't have a digital currency because you wouldn't buy a bond with Bitcoin, and you don't really have a stable coin where you don't have counterparty risk. So you would still pay it in the traditional financial way. And therefore, you still have gaps in the market that you have to solve for around also secondary trading. There's no real exchanges on which you can trade this. And settlements, which to some extent does the blockchain, that have to be solved before we see this at scale. But the fact that multiple entities ranging from the World Bank to Nomura to a number of other financial service institutions are actively looking at this proves that there's potential. It requires time, it requires close collaboration with regulators. And I think that it's a moving target, as mentioned, that we'll get there.
How much counterparty risk do you guys see around stablecoins? You touched on it.
To date, it's nothing we're really looking at the current stablecoin market. I think USD Tether is the largest with 10 billion, so it's not really a meaningful sum. And they're unregulated, offshore, they have legal issues and so forth. Others are very interesting. It'd be interesting to understand how much of these are used as payment means versus crypto to crypto trading. So I think the current use case for stablecoins is mainly for financial speculation. When Bitcoin goes down, you see stable coins increase in value because everyone moves out of Bitcoin and moves into USDC because it's faster. And when Bitcoin goes up, you see a reduction in stable coins and an increase in the price of Bitcoin. There's not too many use cases. I think it's extremely interesting in terms of cross-border payments. If we see more and more of these adoptions really around the payment case, and that's something that central banks are actively really looking at because of global stable coins, then we'll see more adoption. And obviously it's something that a financial service institution like Nomura, which is actively collaborating in the financial currencies market and FX market, would look at.
So we touched on central bank digital currencies. We've touched on security tokens. The one thing we haven't really discussed is the companies that are trying to get into the space. There was a great buzz around Libra when Facebook tried to create their own currency. What do you think the implications are? How realistic do you think it is that we'll be seeing these soon? And where do they fit into the picture? So
I think Libra is an extremely interesting project. Obviously, one of the reasons I'm proud of the Libra team is because it started the conversation around digital currencies with a value that any customers would know. So obviously Libra, initially they wanted to launch a Libra basket pegged to a number of fiat currencies. Now they want to do individual currencies. So it's very interesting to see this shift. I think they have the right manpower behind in order to develop a system that might be more efficient than the traditional means of payment. The question again is, once we see it live, what will the initial use cases be? Will it be to do on-ramping into the crypto world? Will it be for cross-border remittances? Will it be for payments? I think it's very interesting. If you look at how central banks are responding to this, it definitely started the conversation, which I think is very important. Every central bank, to some extent, makes it a priority now to develop a central bank digital currency so that they can compete with global stablecoins. If you look at the FSB report that was published, I think 2-3 weeks back, it's very interesting that central banks understand the potential of global stablecoins and they want to create competition whilst be able to regulate it. So they want to come out with standards by the end of 2022, 2023, which might be pushed back a year or two, but it will definitely create a market, and then it ultimately will be up to the end user whether he wants to use a Libra token or whether he wants to use a digital euro.
And then obviously we see companies like JP Morgan that are, for cross-border payments are creating their own tokens as well, right?
Yeah, but that is more, again, internal efficiency use cases, I think. So obviously it's a closed network of participants. It's pretty close to JP Morgan clients. And so obviously there's benefits internally, but the question is, would they want to roll that out internationally?
I'd like to remind everyone who's listening, in a couple minutes, we're going to get to the questions from the audience. So please feel free to add more questions and ask them, because I will ask Sebastian those soon. Going back to discussing the PayPals and of the world, one big roadblock to adoption is crypto not being available to purchase through large brokerages like, Charles Schwab and E-Trade. When do you think that that's going to happen?
I'm not fully sure, to be honest. It goes again to the point around infrastructure. I'm not fully sure what their internal initiatives are, but there's a lot of involvement in the space. There's a lot of investment that has flown into the space around corporate venture capital and venture capital. There's a number of large-scale financial service institutions that are building infrastructure, such as we have been doing over the past. You need all these components together in a regulated way for these institutions to gain access. Obviously, the ones you mentioned are mainly focused around the US. So it will depend a lot on what the US wants to say. In the US, there's still a fragmentation of regulation between state from state. It'd be interesting to see how those two targets move at the same time. Obviously, the regulation will only evolve as they see fit, as they see that the right infrastructure is supporting the market. And the right infrastructure can only go live fully once the right regulation is there. So it will definitely take some time. I think announcements like today from PayPal are very positive for the market, and they will give initial use cases and test cases where we can see how much is the actual adoption, how many users will want to use it. If you can pay for your groceries with Bitcoin next year, would you actually do it? It'd be interesting to see how many people want to do that. And then we'll see how that actually impacts the overall market and movement from other companies into the space.
I mean, the United States is arguably the most difficult regulatory environment to navigate for anyone in the crypto space, which is a bit strange and seems counterintuitive, but has seemed to be the case. From your perspective, what do we need to see from the United States government? What kind of statements or regulation do we need to see that people will be confident to start, letting Americans even trade on their exchanges or utilize these products?
Yeah, to some extent, I wouldn't agree. I think the US has been doing a lot in the space. We've seen the recent OCC letter around US banks being able to do custody. We've seen other areas around stablecoins and clarity. It's, again, an international effort. So as a regulator, you need to get it right. You don't need to be the first. It's not a massive market that will disrupt the traditional financial markets tomorrow. It will be a couple of years at least before we see widespread adoption. And so it's really, I think, do you want to risk it? And the way, how do you risk it? There's a number of regulators globally, including the FCA in the UK, that create sandboxes and want new companies actually to proactively go to the regulator, discuss the way they would want to do things, how their users, how they do KYC on the user, how they give access to this new world to the users. And they're doing test cases in sandboxes that range from 2 to 6 months, and then regulation is established. But it will definitely be a moving target. You need more collaboration. You need more companies in the space. You need, to some extent, more competition as well, so that the bad actors and the inefficient companies fail, so that you create more maturity in the market overall.
I know that, and agree with Pal, obviously you don't have to be first, but you have to do it right, as you've stated a number of times. But obviously there are countries that would like to be ahead of the curve, like China with a central bank digital currency, because they would like to threaten likely the dollar as a global reserve currency. Do you see that as a possibility if they get far enough ahead that they could somewhat detach their reliance on the dollar?
The question is, how far ahead can you get in this space? It's not rocket science to create a distributed ledger. It's a question of how do you reach adoption? Obviously in China, if you have, it's a more centralized states, you have...
They can force it.
I wouldn't put it that way, but it's your way, fine. So it's interesting to see how the adoption will be, how many merchants will accept it, and what you really do. It's a reserve currency becomes a reserve currency because it's global. So the global world has to have access to this. If it's as controlled and as previously reduced as you mentioned, then would you seriously think that the US or any actual entity would adopt a Chinese currency as their reserve asset? It's a question.
Right. I'm going to move on and ask a few of the audience questions because we have a few great ones here. First, do you have any idea how MicroStrategy, Square, and these other large corporations are actually custodying their Bitcoin?
I think Square published a report that they have an in-house solution. I think they have also published the source code. The other companies, I'm not fully sure. I assume, or I would hope that they use a regulated custodian. If they don't, I would tell them to reach out to Komaino, which definitely can service their needs. But yeah, I hope they have a custodian because it's I'm pretty sure they don't keep it on any exchange.
Can you talk about, I guess, just a little bit more about how that custody actually works, how you guarantee that it's secure, how you guarantee that the proper people have access to the keys, who owns those keys, how do you actually transact if you need to move the Bitcoin and such?
Yeah, so there's different ways of doing it. I think there's some in-house solution where they would split up the keys in a number of areas. There are different technological approaches as well. So you have something called MPC, which is a technology used by some companies in the market. There's also cold storage, so where you keep the keys in offline vaults. Then there's a midway between these two where you have hardware security modules, where these are offline, but also have quick access online, so you can move transactions fairly fast. And then it goes from entity to entity, how they want to distribute roles and systems. For Komano, for example, there is a very clear segregation of duties, so that not one person could move funds in and out of the company. Obviously, it's a regulatory requirement, but it's also something that is comfortable with clients. And then as clients have specific needs, depending on their size, on their amount of assets that they hold, it's something that Komano would work with the client to really establish the clear security guidelines, and Komano would be able to give them the right suggestions and approaches to how to do things.
Understood. Another question from the audience. How do you see prime brokerage working for crypto?
I think it's a very interesting market. Obviously, you see a number of the traditional custodians moving into the space, from BitGo to Coinbase to Fidelity. It links up, it works as the market is small. I think at a later stage, we might have some segregation of these purely mandated by the regulators to avoid risks. But it's definitely an interesting segment. So once you have assets under custody, if you see for one of the biggest businesses right now is a repo or lending of coins, or lending on the collateralized coins. That's definitely an interesting business line, something that I don't think any custodian would exclude. But it's an interesting market that helps one gain education, to link up secure custody with the liquidity venues. And it's definitely beneficial for the market if you create one-stop shops, for example, for an institution to go to, so that they can get their crypto as well as custody them.
Right. You want them basically to be able to do everything that they need to do under one roof, effectively, right?
Yeah, that's to some extent how the traditional financial market works for, as you mentioned, Charles Schwab. You can go and you have it front to end without having to have one custodian, one exchange,
right,
and so forth.
So there was a lot of noise about the OCC announcement, which touched on earlier a little while ago, and recently nothing. Can you speak to how this regulatory update would have impacted how banks are looking at crypto?
As mentioned, we've been looking at custody since 2018. So I think we might have been the first or very early on in the curve, simply because we see custody as the foundational enabler for your overall digital asset strategy. I think banks, they haven't not looked at the space, and suddenly the OCC comes up with new guidance and they start looking at the space. But I'm pretty sure that every financial institution, or I would hope so, is actively looking at the space. The question now is, how do you do it? Most of these companies don't really have experience in the space. It's not that they can say, okay, tomorrow we're going to be digital asset custodian. There's a lot of scams in the markets. You need to understand the right technology. You need to understand the right regulation and the right partners. And to some extent, Komano is exactly doing this. It's acting as an enabler for new financial services institutions that want to gain exposure to the assets. And so if American banks are looking at the space, it's either you find the right partner or you take more time to try to build it in-house with all the ramifications that come with it.
Right, you basically answered it, but this was another question from the audience. Nomura has its own custody solution, but do you think other banks will try to acquire crypto custody providers?
Yeah, so to clarify, Komano is not a subsidiary of Nomura. Komano is a standalone entity regulated by the Jersey Financial Services Commission. So any institution that wants to acquire a custodian, I think I suggest it would first go to Komano and speak to see if Komano can meet their needs. And I'm pretty sure that Komano can do it the best way right now in the market.
Another question. An ETF has been FINRA approved finally. I don't think that's necessarily true, and is expected to begin trading in 4 to 6 weeks. No ticker yet, but Schwab and other traditional accounts will be able to custody and trade. And then he said, sorry, I need to clarify, not certain if it's a fund or an ETF, because I have not seen an ETF approved, to be clear.
I also haven't seen it. I mean, it'd be very interesting to see when it goes live what the actual market impact is. So obviously we've heard a lot of news around an ETF is going to change the world. It's one of the questions you asked me previously, but there's a question if it's actually going to be the case. If you look at derivatives, also I think it was also in 2017, you see derivatives starting to enter, CMEs doing derivatives, Backed has launched. There's going to be a huge uptick in the market, which actually did not take place. So now we see more involvement. We're seeing volumes of derivatives increasing significantly over the past months. So I see it's not something goes live today, tomorrow everyone's going to use it. It's again, this learning process, which I think is the fundamental challenge right now, that institutions need to be educated around the assets, they need to be educated around the technology overall, and the potential to be more incentivized to actually gain exposure.
Right, and grayscale products are wildly popular with retail. I mean, they're not ETFs, of course, and they trade way off NAV, and there's a huge premium. They're not great products, but I mean, we have seen a ton of interest in products that are trading on the, that can be traded like stocks.
Yeah. No, I definitely fully agree. Grayscale is one of the leaders. I think it's the biggest in terms of assets under management. They've continued to show more and more inflows over the quarters. So I think it's definitely interesting for the market and just proves the point that more and more retail investors are moving into the space for their own reasons. It might be because of a different sort of value. They want to gain more portfolio, their diversification, they're afraid of inflation and the devaluation of the dollar. So everyone has his own reasons. And I think the more retail adoption you see, the more you have also institutions servicing retail customers moving into the space. And that obviously then leads wholesale institutions and larger financial services institutions also to take notice of these developments and be more proactive to service it in the right way.
Another great question from the audience. In 2018, Goldman was talking about opening a trading desk. What would need to happen for investment banks to consider opening crypto trading desks?
So the first thing you need is custody and a secure, regulated digital asset custody solution. Secondly, you would need to source the right liquidity. So a big problem with Bitcoins, for example, a regulated custodian such as Komano wouldn't accept any coin. The coins can be traced, and coins that have been used in illicit trades or drug trafficking in the past wouldn't be accepted. So there's a number of companies innovating in the space to look ranging from Chainalysis to Elliptic that look at the provenance of tokens. You need definitely more clear data in the market. You need to know more education. There's not too much research being published around Bitcoin, definitely not from financial services institution in line with their traditional market or equity reports. You need liquidity, as mentioned, and the right trading venues, and then you also need the right counterparties. So to some extent, I don't think any large financial scale institution would trade with any company with coin in their name. So you need more adoption from, I think, initially the traditional asset managers, and then later the traditional liquidity venues, and to some extent traditional exchanges, so that you can service it in the right way. And that goes back to the point around having a front-to-end digital asset value chain that is regulated, secure, and up to the standards of today's financial market.
Doesn't the market also need to be much bigger? I mean, as you touched on earlier, the market cap of Bitcoin is a couple $100 billion. I mean, don't we really need to be at a Bitcoin price of $30,000, $40,000 and a market cap of multiple trillions for really big money to be able to move in and out confidently?
Yeah, but it's a two-sided coin. In order for the market to become significantly bigger, you need significant money. And retail investors don't really hold that significant money to date. And also the early Bitcoin adopters were people my age that to some extent don't have much money, but are looking at this new asset. If you look at my grandmother wouldn't invest to Bitcoin to date because her bank doesn't tell her to do so. If you see more and more retail accumulation and now the start of corporates moving into the space, good news such as PayPal and so forth, driving use cases and adoption, then you'll see the price grow. But I don't think there's a specific target that the price has to reach or the market cap has to reach 1 trillion before institutions say, okay, this is the right level, let's get in. But I think if the discussions around Bitcoin moving to 1 million are correct, and I have my concerns, then would you really care if you buy at 10,000 or 20,000 if you're an institution?
No, of course not. It was more, I guess, a question about sheer liquidity and knowing that you'd be able to exit. If get in and out seamlessly, but knowing that you'd be able to, be liquid if you had hundreds of millions of dollars in it.
Yeah.
Or billions.
The right counterparty that ensures you that if you want to go back with your Bitcoins, they'll give you the fiat or central bank digital currency or stable coin in the future.
So this is another great question because I have a lot of Wall Street friends. I'm sure you do as well. And they all were consistently laughing at me in 2017 and 2018. And they've stopped laughing to some degree, or at least started taking it seriously. And the question is, what is it like to try to sell crypto initiatives internally? Has the level of buy-in, general education gone up in senior bank executives?
Yeah. So I think Nomura, being a Japanese institution, has always been very innovative, and we have a very innovative culture. So as mentioned previously, already in 2014, 2015, senior management understood the concept of having a native digital assets on a blockchain. Now, did they think of Bitcoin being categorized as an institutional digital asset? I wouldn't say so. And definitely the discussion around that has changed over the years. Now there's more openness to explore opportunities in the space. It's not a winner take all. And so I think it's the whole journey that has to fit the right milestones. So obviously, when we look at Bitcoin, it's not that we want to service Bitcoin. If we want to service Bitcoin, it's because we also want to service security tokens, central bank digital currencies, and the broader market. As mentioned, it goes back to Bitcoin being a small asset. It's still a small asset, as we just said. If Bitcoin reaches meaningful scale, then I'm sure that more and more discussions will be held. It will be featured more in mainstream media, and also speed will pick up.
The next question, which players and types of institutions do you see better positioned to provide new wealth advisory solutions for digital assets? What changes do you see to the wealth advisory industry as digital assets grow?
Yeah, it's interesting. It goes again around the narrative around Bitcoin, and it's something that I don't think is fully established as of yet. So the question is, do you see Bitcoin as being a payment system, or do you see Bitcoin as a store of value? And how much value do you put? So I did an internship in a private bank in Zurich one summer, and there obviously the portfolios are traded in a very risk averse matter, where you don't want to take much risk because you don't want to put your retirement fund or money for your grandchildren into an account that gives you an okay yield, but is completely risk-free. Bitcoin, I don't think, would fit that criteria as of now. It can be part of your portfolios. We've seen a number of studies that it has a positive relationship around the risk reward, and it has the potential ROI. But there's a question as to the market. I think, again, the infrastructure has to be there. You have to get able to go in and out of the market fast enough at the right size so that any manager would suggest it to their clients. Because, again, it's all based on trust. If you're not trusted in the system, or if you reduce the trust, then you rule out to lose your whole business model, not purely the digital asset side.
Funny, there's not many places that grandma can park her cash with a wealth advisor now that are going to give a guaranteed yield with no downside risk. But it's been a good idea historically.
Yeah, but the Bitcoin gives you risks. Bitcoin, to some extent, apart from the price, doesn't give you yield.
Yeah. We have 3 minutes left. I'm going to ask you one question and then let you give your parting thoughts. The last question from the audience is, what is the holy grail for crypto settlement for institutional players?
Holy grail for crypto settlement? I think, again, you need the right custodian. So currently there's massive inefficiencies in the markets, especially with custodians. If you want to trade, you have to trade on different liquidity venues. You might have to move your assets from your custodian to an exchange to then move it again to another exchange.
Right.
And it's quite inefficient. So it's definitely an area that we're looking at. It's an area that Comano as well is looking at, around how you can settle within custody to some extent to keep it secure and efficient as possible.
So like a political debate, you have 1 minute for your concluding thoughts.
Thank you very much. Thank you, Julie, Blockworks Group, and Agrant, and you, Scott, for this meeting. Very interesting. I hope it was insightful on your end as well. Thanks to the audience. And then you can find me on LinkedIn. My name is Sebastian Widmann. I'm always interested in speaking to digital asset startups, entrepreneurs, investors in the space that think that we can collaborate with Nomura. If you're interested in custody, I'm more than happy to introduce you to Komainu. And yes, also if you want a discussion, feel free to reach out to me.
Yeah, everybody make sure to catch up with Sebastian after this if you have more questions. He's definitely the guy that you need and has all the insight here. Once again, as he said, I would love to thank Sebastian for being here. Thank you for taking your time. Also thank Blockworks for putting this on. Really just amazing to have this consistency and this level of conversation. And then once again to Algorand for sponsoring an incredible platform, and one that all of you should definitely check out and take an interest in after this. Thank you all so much for participating and taking the time, and we'll look forward to seeing you at the next one.